Hello. Thank you for joining this update on LIBOR reform. Over the next few minutes, we will cover what is happening, how that may affect markets and your organization, and what CBA is doing to help you. As a recap, LIBOR is a widely used financial benchmark rate, published in 5 different currencies and 7 different tenors. It is based on daily submissions of estimated borrowing costs by LIBOR panel member banks to the LIBOR administrator. The UK's Financial Conduct Authority, or FCA, oversees LIBOR. In 2017, FCA announced it would no longer compel the panel member banks to submit their rates after the 1st of January 2022. This meant the future of LIBOR cannot be guaranteed beyond that date, and we need to prepare for its discontinuance in a little over a year's time. In broad terms, this means that the market has to firstly transition to alternative rates, and secondly, to amend existing contracts that reference a LIBOR rate. The alternative rate identified to replace LIBOR are risk-free overnight rates, or RFRs. These are being adopted in each of the 5 jurisdictions in which LIBOR is being published. In addition to LIBOR, there are other so-called IBOR interest rate benchmark rates that reflect bank borrowing costs. These include, for example, Tokyo Interbank Offered Rate, called TIBOR, the Euro Interbank Offered Rate, called Euribor, and also Bank Bill Swap Rate, called BBSW. These rates are not overseen by the FCA directly, and as of now, they are not at risk of discontinuance. This slide shows the 5 different risk-free rates that have been identified as a substitute to LIBOR. These rates are all overnight rates. The risk-free rates of the US and UK will be the most widely used given the size of their markets. The transition from LIBOR to the risk-free rate is presently more advanced in the UK market than it is in the US market. Notwithstanding the differences in the pace of adoption, both jurisdictions are working towards the same deadline of the 1st of January 2022 to be prepared for LIBOR cessation. COVID-19 has not altered this deadline. The adoption of risk-free rates involves substantial change to, among other things, systems, accounting, and interest rate calculations as we go from a forward-looking rate like LIBOR to an overnight rate. The risk-free interest rate calculation typically would be on a compounded in arrears basis, so that a string of overnight rates is in effect translated into one amount at the end of an interest rate period. This is fundamentally different from LIBOR, which gives cash flow certainty at the beginning of any interest rate period. Generally speaking, this change might challenge corporate clients who are unlikely to have traded compounded in arrears products and who may have less sophisticated systems than financial institutions. That is one of the reasons why the transition to these risk-free rates is proceeding more slowly in the loan markets than it is in the derivatives market. Given that the compounded amount is known only at the end of any interest rate period, market standards are, broadly speaking, developing an adjustment in order to provide cash flow certainty in time for settlement. That is typically done by shifting the interest period backwards, so that the reference period of overnight rate observations is slightly ahead of the actual interest period. While risk-free rates compounded in arrears are expected to be the primary method for replacing LIBOR, it is possible that in some jurisdictions, forward-looking term rates derived from these risk-free rates, so-called term rates, may be developed. The attraction of these term rates lies primarily in the fact that they allow the user to know at the beginning of the interest period how much to pay throughout the interest period, which is similar to how LIBOR functions. However, it is anticipated that the use of any term rates will be limited, and regulators have urged market participants not to delay transition in the hope that term rates may arrive. Regulators have also recognized that compounding interest rates in arrears may be challenging for some small and medium-sized enterprises, who may choose alternatives, including fixed rates. So now that we have spoken about these new rates, we will discuss the issue of legacy contracts that still reference LIBOR. Typically, financial contracts had a reference to LIBOR being unavailable, but that unavailability was always assumed to be temporary. In order to deal with LIBOR's permanent cessation, contracts needed to be made more robust. A number of industry groups have been working on exactly that, by developing fallback clauses to be activated in the event LIBOR is discontinued permanently. These fallbacks consist of three elements. Firstly, there is the trigger event, the point the trigger from LIBOR to the new rate is activated. Most fallback clauses speculate that a trigger event occurs when LIBOR is no longer published or when regulators put restrictions on its use. Secondly, there is the interest rate that will replace LIBOR. You will not be surprised to hear that upon the discontinuance of a LIBOR rate, the replacement will be the respective risk-free rate compounded in arrears. And thirdly, there is the spread adjustment. Risk-free rates are overnight rates, while LIBORs are available in multiple tenors. Additionally, LIBORs incorporate a bank credit risk premium, while risk-free rates do not. As a result of these differences, adjustments to the applicable fallback risk-free rates are required to ensure that contracts referencing LIBOR will continue to function as closely as possible to the original agreement in the event that fallbacks are activated. In the derivatives market, the adjustment that the International Swaps and Derivatives Association, known as ISDA, has landed on is that the compounded overnight interest rate will be adjusted by the median difference between LIBOR and that compounded risk-free rate over the past 5 years. These fallbacks were published on the 23rd of October 2020 and will take effect on the 25th of January of next year for new derivatives trades under an ISDA. Derivatives users may also opt to incorporate these fallbacks into existing or legacy trades by signing onto an ISDA protocol which will take effect at the same time. Industry bodies for other asset classes, such as the loan market, are considering similar approaches to contractual fallbacks in their documentation, including very similar adjustment calculations. That said, the implementation may be less standardized than it is in the derivatives market. Therefore, we encourage you to carefully consider the language of, for example, LIBOR loans and the derivatives put in place to hedge these loans. Despite the adoption of fallbacks to manage the contractual risk of LIBOR discontinuing, many market participants are likely to transition portfolios away from LIBOR before the 1st of January 2022. Between now and 2022, we expect market liquidity to shift increasingly to RFRs, and the publication of industry-wide fallbacks can assist you in deciding how best to transition away from LIBOR. It should be noted that working groups have recommended specific timelines to limit the use of LIBOR in new contracts. So, for example, the Sterling Working Group recommends that come the second quarter of 2021, no new LIBOR loans be written. The US Working Group recommended a Q3 2021 deadline. Similarly, the US Working Group recommended that from the 1st of October 2020, all LIBOR referencing loans maturing past the 1st of January 2022 must incorporate so-called hardwire fallbacks. These fallbacks offer certainty about the calculation of the successor rate and its adjustment. We recommend that you keep track of various timelines as they can help you plan your own preparation schedule. Risk-free rates working groups in various jurisdictions have provided helpful guidance not only on implementation timelines but also on, for example, operations and systems challenges that the transition to new rates will present. The transition away from LIBOR raises a number of operational, legal, and financial challenges. Regulators have provided guidance on what steps market participants can take to start preparing for the transition. These include: firstly, establish where your LIBOR exposures are, which ones mature past the 1st of January 2022, and understand which of your contracts have specific references to LIBOR in the various currencies. Secondly, check your contract terms. Understand not only the notional exposure to LIBOR that you have, but also the contractual details of those exposures. What kind of clauses are there in your contracts, for example? Are you, for instance, hedging a loan with a derivative? We encourage you to familiarize yourself with risk-free rates and what they mean for you and your business, and speak to your bank or product provider, or consult with a financial services professional or advisor. You may wish to seek independent advice regarding any legal or regulatory obligations that may arise through implementing different transition options, including, but not limited to, derivatives transaction reporting rules, margining and collateral requirements, or clearing obligations. These requirements may apply to you and us differently in different jurisdictions. As this information is prepared for information purposes only, it should not be taken to be advice. You should seek independent advice on these matters. The Commonwealth Bank has a group-wide transition program and has developed the capability to transact in risk-free rates to assist in your transition. We are actively contributing to industry consultation and LIBOR transition working groups. Through its interest rate benchmark reform program, CBA is undertaking the financial, legal, documentation, and systems changes required for LIBOR transition. We plan to approach you in the near future to discuss LIBOR, including the possible need for contractual changes. For regular updates, please visit our publicly available LIBOR Information Hub. If you have any further questions regarding benchmark reform, please contact your Commonwealth Bank representative or the Interest Rate Benchmark Reform Program directly at irbr@cba.com.au. Thank you.